U.S. stocks underperforming non-U.S. stocks again today as the S&P struggles to hold its bid. Michelle Gibley is back with us, Director of International Research at Charles Schwab. It's been the international year, obviously, Michelle. Just kind of firstly, I'm curious your thoughts on generally how you think U.S. stocks and international stocks can work together. Is there a potential that maybe U.S. stocks bounce back and it doesn't have to come at the price of the international ones?
Well, sure. What we're seeing, it really is just a reset of expectations in both the U.S. and in Europe in terms of what the economic growth will be for this year, earnings expectations and valuations. I would say that, U.S. stocks are still pretty highly valued, and that's not really the case in Europe.
When you look at, this afternoon we're talking also with our guest Jack Kirsch at Russell, and this morning in our conversation with another guest about international, it seems like a lot of folks are viewing it through that valuation lens as a kind of almost like factor-driven reset. What do you think is the impetus for that? Is it big, like portfolio managers? Is it more kind of like long-term investors, pension funds, or something that say, we're happy to diversify into something lower valuation, higher value characteristics?
Yeah, just think about what we heard so many times, which was U.S. exceptionalism. And if you took out NVIDIA from the S&P 500, it was really just NVIDIA outperforming the European stocks because S&P excluding NVIDIA were about the same performance last year. And so once we had that crack in the AI story, that was really when the door opened to say, okay, what else is out there? And we've been ignoring international for a long time. And then you've got these changes in policies that we're seeing in Europe, where these America First policies here are forcing them to take a look at what they're doing to boost growth. And in Germany is really the key here. And they're really just looking at a bazooka of fiscal stimulus on infrastructure and defense spending. And that is really a big change. And if they approve it, it could break them out of stagnation and really define the next decade for the country. So it's actually potentially a growth story now.
Okay, so that's kind of where it gets interesting, because if it's real growth and not just kind of one-time policy recalibrations, then that could be more sustainable. It seems longer term.
Yeah, that's right. The infrastructure plan alone is 11.5% of GDP. Now, that's not going to be all in 1 year. It's going to be maybe over 10 years. So that's something that can continue to propel growth. And, it's not just defense names that are outperforming, because we're also, been talking about defense spending. European banks are outperforming U.S. banks by 20 percentage points this year. And so it's growth across the Eurozone that could potentially get a boost. And we're seeing earnings expectations being revised higher and economic data coming in ahead of expectations. And again, that's before any new fiscal stimulus. And Eurozone stocks are trading at just 14 times next 12 months earnings. So they're still attractively valued, and investors have ignored them for a long time. They're likely underweight.
Okay. Do you think generally these are the type of investors? This kind of comes back to the question about the kind of, I think I'm referring kind of simply to my kind of tiers of investors, but like the big kind of slower moving ones like a pension fund. Do you think those are the types of investors that are doing this, that are not going to be as active, that are just going to park money here? And how do we monitor that stuff? Because if it's just like a bunch of hedge funds that thought there was like some kind of Trump blowback trade, then they might be out tomorrow if it looks like NVIDIA is going to rally back.
Yeah, I think that's where the question is. Is this something durable? Is this just a trade? If they can break, if Germany can break out of stagnation, that could be a durable trade. And I think that, the slower money that doesn't, makes changes over a longer period of time, they may have, not yet really made any changes. Now, they may have exposure, but they may be underweight depending on how much they rebalance every year. Individual investors for sure are underweight because, a lot of people are like, why should I even invest in overseas? I know the U.S., I'm comfortable with it, and it's outperforming. So I would say retail is definitely underweight.
Okay. Sector-wise, does it? It's interesting because some of these things are kind of a little more services oriented in some ways, which we've generally assumed kind of is that epicenter of U.S. exceptionalism. But in the last block, we were talking commodities, we're talking copper, silver, some of the stuff kind of more connected to the cyclical components of the global economy. Does that stuff still work too? Can we use kind of the textbook kind of process of thinking, okay, if international outperforms, cyclical materials and that type of stuff generally should do well too?
Yeah, if you look at the MSCI EFA index, half of it is in three buckets. That would be financials, healthcare, and industrial. So financials and industrial would be more cyclical, and overall, EFA is more cyclically oriented. It has less exposure to tech in particular. And like I said, financials are already outperforming by a wide margin, just kind of on that cyclical upswing that we're anticipating.
Okay. I appreciate the update. Nice to continue to pry open the analysis on this. Appreciate it very much, Michelle. Good stuff.